Okay, we're going to continue on with journal entries, and on this one we're actually going to do the journal entries, and the next slide we'll probably post them into the T accounts. And if you notice the T accounts tabs at the bottom here, it says T accounts. When we're ready for that, you just click on that. But first we've got to do this one. Okay, so this is an example. So on January 2nd, Samantha Jones started a printing business set up as a corporation. She invested $25,000 cash. Okay, so remember what I said, the first thing you do is decide what accounts are affected. Well, she invested $25,000, so that means she give cash to the company, and by giving cash to the company, that means we increase it, and remember on an asset, you debit an asset. Okay, so we have cash, and that will be for $25,000. And then set up as a corporation, so Samantha is going to receive common stock, and that will be for $25,000. Okay, so both of those increased, and that's what we want to show: a debit to the asset and a credit to the equity account, common stock. On January 3rd, Samantha paid $2,700 for supplies to be used by the corporation. Okay, so on this one, she paid, so we decreased the cash. That means that cash is going to be a credit. But what did we purchase? Well, we purchased supplies. So that we want to increase the asset supplies by $2,700. We know debits always go first, and then we want to decrease our cash account by $2,700. Then on January 3rd, we paid $800 to rent space for the print shop. Okay, so again, we paid out cash, so it was for rent, so we want to debit rent expense for $800, and we will credit cash for $800. Okay, so on this one, we increased the rent expense account. You go back to your T accounts that we did last time, and we want to decrease the cash account. Okay, this is going to be this is a three-liner. So on January 5th, the print shop purchased equipment for $12,000, paid $4,000 in cash, and the balance was on account. Okay, so we'll get that fixed. The balance was on account. Okay, so what did we purchase? Well, we want to increase the account called office equipment. I think that's what I called it in the other page. And that's for $12,000. Now remember, it doesn't matter when we pay for it. So we did pay cash out for $4,000 and accounts payable for the balance, which would be $8,000. Okay, so what did we do on this one? Well, we increased the office equipment account for $12,000. That probably should say office equipment up there. We decreased cash by $4,000, so that's okay. They're on the same side. So if you increase one asset, you need to decrease another asset if they're both assets. And then we want to increase liability, though, by $8,000. Okay, so that's what we did here. So that's what the debit will increase office equipment. The credit will decrease cash, but a credit will increase the accounts payable. On January 6th, we purchased a one-year insurance policy for $1,800. Okay, since it's 1 year, it's not going to be an expense account, it's going to be a prepaid. So we will have a prepaid insurance for $1,800, and you pay that with cash, and that will be for $1,800. So again, we increased the prepaid insurance, which is an asset because it's a claim against the insurance company, and you decrease the cash because that's what it took. You paid out cash. On January 8th, we collected and received $600 for print work completed and delivered. Okay, so we received cash for $600, and we're going to credit service fees earned for $600. Okay, this is going to increase your cash because that's the account. Since you received cash, you want to increase cash, and you want to increase your revenue account, which is in this case called service fees earned. On January 10th, we purchased $300 of supplies on account. Okay, so again, we increased our supplies account by $300, and it's on account, so that means we charged it, so that's going to be accounts payable for $300. So on this one, we increased supplies by $300, and we increased the accounts payable by $300. On the 15th, we billed a client for printing and delivered $250. Okay, this was a charge by the client, so that's an accounts receivable. That means they owe us the money, and that's for $250. And we'll credit our revenue account, which is service fees earned, by $250. Okay, again, we increased the accounts receivable, which is an asset, so that's a debit, and we increased our revenue account, service fees earned, so that's going to be the credit. On January 18th, we paid for the supplies we purchased on January 10th. Okay, so on this we want to get rid of the liability, so we'll debit accounts payable, because remember, to reduce a liability, you debit the account, and that's for the $300, and we'll have to credit cash because we need to reduce the cash by $300. Okay, so that decreases both the accounts payable, because that's a liability, so that's a debit, and we decrease cash, which is an asset, so that's a credit. On the 21st, we collected and received from the client that we billed January 15th. Okay, so since we collected and received, that's cash for $300. Nope, sorry, $250. Got the wrong line there. It's this one right here, January 15th. And we want to reduce the accounts receivable by $250. Okay, so this increases the cash and decreases the accounts receivable. So both of those are assets, but one increased, one decreased by the same amount, so we're okay. And the last one we have here is Print Shop declared and paid $200 dividends to the owner, Samantha. So we want to debit dividends by $200, and we credit cash by $200. Now what we did there was we increased the account called dividends, which that's an account by itself. That carries a debit balance. Okay, so by $200, and we decreased the cash by $200. So we're okay. Okay, that's how you do journal entries, and that's probably enough for now. And the next slide, we're going to post these into the T accounts right there.